Dealers, early access to our private dealer chat groups is now open. Join top dealers at cdgcircles.com. That's cdgcircles.com, or hit the link in the show notes. I'll see you inside.
You know, we see Hyundai and Kia stores now regularly making north of $5 million, sometimes more than $10 million per location. That never happened a decade ago. So there are some really good brands out there to buy. Conversely, you know, the Nissans and the Stellantises and the Infinitis and the Lincolns and the Volvos are really, really challenged today.
Yeah. I mean, look, it's also, you know, there's more money, you know, more capital chasing fewer assets. Kia, I mean, it's one of the incredible just accomplishments here over the last 5 to 7 years of how far they've come. Today, I'm joined by Alan Haig, president of Haig Partners. While headlines scream volatility, dealership buy-sells are booming. Alan breaks down what's driving the surge, which brands are winning market share, and how dealers are positioning themselves to thrive in a rapidly changing retail landscape. A big thank you to our sponsors for making this episode possible: Equifax, Amazon Autos, and of course, Haig Partners. And now let's get into the show. Alan Haig back on the CDG podcast. Alan, welcome.
Thank you, Yossi. It's good to be back with you.
Good to have you back on post new NYC marathon. I hope you're hanging in there.
It was a long day, Yossi. That was about a 12-hour event for me. A lot shorter for the faster runners, but for me, I got on the subway at 6 a.m. and I came back to my hotel room at 6 p.m. So it was quite a day, though. It kind of showed the best of New York City, and I mean, it brought out the best of everybody: runners, spectators, etc. And
so, how does that work? I've never participated in a marathon. Like, when you say 6 a.m. to 6 p.m., what period of that are you actually running?
Longer than I wanted to, but for the New York City Marathon, it's unique in that all the runners start in Staten Island. So you have to get all the way over to Staten Island, everybody. And there's 60,000 people that signed up for this race. And so they have to get everybody over there by 7:30, close the bridge, and then they start to launch the runners. So there's so many runners that I started running at around 11 a.m., and I ran so slowly. I had such a bad day. I didn't finish until it was really getting dark, almost 5 p.m. And along the way are 2 million spectators. And I shouldn't call them spectators, because spectators implies passive, you know, just watching.
Yeah.
These were active. These were participants. There was so much energy coming from that crowd, and good humor and support and everything else, that it really made a painful day pretty fun. And there were a lot of funny signs that were out there. There were a lot of funny sayings. New Yorkers definitely have their sense of humor. This morning I was watching a video of the race, of, you know, some people who had run. And I remember passing by a guy who was missing basically his whole right leg and his left leg below the knee. And he had those Blade Runner shoes, you remember, from Oscar Pistorius, on his prosthetics. And he had a couple of canes. And he was a young man. I learned he was from Venezuela. He was in some accident, and he finished the race. And I remember running by him and thinking, like, well, whatever I was whining about, my feet or my stomach or whatever, like, that man was incredible. Wow. And it really showed, I think, the best that people can offer, because people were out there. They set a goal. They worked hard. Almost everybody achieved it. I looked at the stats. 99.3% of the people who ran it finished it. And they finished it. That's a really high rate because of all the fans cheering for them. And, you know, I ran for this charity called Fred's Team, which provides money to Sloan Kettering Hospital for cancer research. And our one team raised $9 million. And that we were one of many that were running, you know, as a charity. So it was just a wonderful day. It was the best New York City has to offer, and I felt just privileged to be a part of it.
That's incredible. Great work. And I should say, this is sort of impromptu. I didn't even plan to chat about this, but in not so positive news, I'm sure you saw the news about CarMax, new CEO, or I should say, Bill Nash resigning. What do you think about that? I'm curious if you have an opinion on what's happening over there.
I'm not a real expert on CarMax. You know, I think that if you look at the development of Carvana, I have to think that the board members and the investors say, wait a minute, why aren't we Carvana? We were here well before they were. We've got the clicks and the bricks. Carvana's just not getting into the bricks with their acquisitions. We've had physical dealerships. We've had a buy online. How are they worth, so much more than we're worth? I believe that Mr. Folliard, I've heard he's a brilliant man. I don't know him personally. So I suspect that they will improve. I suspect, and again, I don't know this, but you might have some disgruntled shareholders. And now, if you look at what Carvana's done, it's just quite impressive. If you believe in their business model or not, the amount of value they've created for the shareholders, the experience they give to their consumers, the impact they've had on our industry, it's significant and really just less than a decade. And they're not done. As you know, they've been buying some new car stores, so they could have an impact.
Yep.
Not only on CarMax, but on the stock price of the public retailers as well.
And you, of course, know that we launched CDG Circles, which is, primarily our dealer chat groups and beyond. And one of the conversations in one of the circles has been about Carvana, and, dealers are sharing different, tips and insight they're hearing from their reps and from, the manufacturers. But all signs seem to be pointing to more acquisitions, more franchises, more dealerships for Carvana. You had written a letter to Elon Musk about a year ago or 2 years ago, maybe, and you said, "Hey, Elon, you should embrace the dealership model." Mm-hmm. And they did. I forget who. Someone. It generated lots of press. I mean, it went viral, online in the Twitterverse and whatnot. But it's funny to see that Elon, while he hasn't adopted or embraced it, Carvana since has. I actually recorded a podcast with Ernie Garcia, and I said, and on the podcast, I said, Ernie, so when are we entering the franchise realm? And he didn't respond on the. He's like, oh, I have no plans right now. And then 2 months later, they're like, we're entering the franchise realm. And obviously, this had nothing to do with my podcast. A public company doesn't make these types of decisions in 60 days, but it was pretty funny timing that they've since entered and are selling new cars online.
Well, a lot of research has shown that the majority of customers still want to come in and touch the product. Maybe they need help with financing. Maybe they just need to understand the difference in colors or packages or whatever. But the large majority of customers still want to come into a physical dealership to transact. And if you're Carvana and you want to own the used car space as much as you can, it limits the number of vehicles you can sell if you can't get them into your physical environment. So, I think Carvana should speak for themselves in terms of their future plans, as opposed to me speculating. But this allows them to address a much bigger share of the market. And certainly there are people that will buy a new car sight unseen. We realized that during the pandemic, they'll buy a used car. And then on the new side, in some ways, that's even more of a commodity product, right? Because it doesn't have any scratches. It doesn't have any smell. It doesn't have any wear and tear, right? It's totally new. So it really is a commodity. We expect that they'll put to use their expertise in marketing, their expertise in financing, their expertise in insuring, and provide a very good customer experience. It'll be curious to see on the fixed operations side if that's a big part of their future. Are they going to be expanding the service stalls and expecting more customers to come in? Or is it really more of a new and used vehicle play? That's unclear to me, at least.
So, Alan, talk to me before we get into, starting high level about just the current state of the market. Our last update, of course, we did a quarter ago, right? Where are we at today? Government still shut down as of this recording. Potential chip shortage 2.0. Looks like it's getting serious. Honda dealers sending me memos showing that Honda's just, keeping them abreast of what's happening, but there's no doubt about it that it's real, right?
Yeah.
Consumer is continuing to, or I should say sentiment from what I read online is at the lowest or lower than it was during the recession. And I find that pretty striking. But that's, again, I don't recall right now who specifically measured that, but that's a pretty stark indicator. So talk to us about the M&A market. All that said, that's macro, but what is happening in the dealership M&A market as of now?
Well, the M&A market took a big step backwards in the first quarter of this year. There were almost half as many dealerships sold in the first quarter of 25 as there were of 24. And we speculated that's because, these transactions take at least 3 months, often a year to conclude. So we look back 3, 5, 6 months. What did we have? We had a presidential election going on. And I think that if you're going to be buying a store and spending tens of millions of dollars, you kind of want to know what type of tax environment I'm going to be in, what type of economic environment I'm going to be in. And so I think a lot of deals kind of went slow and sideways or died maybe in the fourth quarter of last year and then the first quarter of this year. After the election, we still have tons of noise. I mean, you mentioned some of it, Yossi, right? But we have two wars. We have the presidential election. We have tariffs. We have a political assassination with Charlie Kirk. We just had a mayor elected, first socialist mayor in this country in decades that I know of. You have the plant fire in Kentucky. You have the chip factory shut down in, is that Holland? I can't remember. On the positive side, you had the carb stuff eliminated nationwide, which is a huge relief to this industry. We got our first rate cut. The EV credits were eliminated. So, I mean, just the whipsaw we've had back and forth, positive and negative news. At the end of the day, how does that all shake out? Dealership and M&A is coming back strong. The number of dealerships that closed in the third quarter of this year, 148 stores closed. So if you annualize that, that's almost 600 stores for the year, which is about, almost the most we've ever seen. And I can tell you in terms of our practice, the number of inbound calls we've had and requests for meetings and requests for evaluations, I'd say it's gone up significantly just in the past 30 days. So, dealers have made so much money since the pandemic started. It's really been 2020, 21, 22, 23, 24, 25. They've just done so well. And the average age of a dealer continues to go up. So at some point, we're going to have a pent-up demand of sellers. And I think that happened a little bit when dealership values doubled or tripled, I should say. Now they're still quite high. But in terms of M&A, I think the market is wide open. I mean, the financings are coming through. The banks are eager to lend. Real estate is kind of recovered. Profitability went up in the second quarter and the third quarter. So dealers are feeling pretty good, but it does vary a lot by brand. I'll tell you that. Some brands are getting no love and some brands are getting all the love.
This episode is brought to you by Equifax. Auto dealers and lenders are in a tough spot. Fraud is more challenging than ever, with fraudsters constantly evolving their tactics. One of the keys to protecting your assets and approving loans with confidence? Thorough identity verification leveraging reliable data. You need to know the consumer and that they can afford the vehicle. Get the data you need to know your borrower better and make fast, smart decisions. Equifax provides instant, secure access to verified borrower identity, address, income, and employment information, helping you move deals forward quickly. Learn how the power of verified data can streamline your process. Visit theworknumber.com/auto today or click the link in the show notes below.
Before I ask you, I was going to go into just what kind of deals or buyer profiles are driving the current momentum. Let's table that for 1 second. Talk to us about brands. Last podcast we recorded, the big news was Audi taking a full turn down in their blue sky multiple. And so I'd love to understand what you're seeing in terms of brand and sentiment across brand with amongst dealers.
Well, you mentioned Audi, so just to follow up on that, the Volkswagen Group as a whole went really, really heavy towards EVs globally. And they stopped innovating anything really on the ICE side. They weren't bringing many ICE vehicles to the market. And it was a bad bet. And we know now that the U.S. government has abandoned subsidizing these vehicles. The consumers, it's less than 10% of the people would like to have an EV with the credit. We'll see what happens when the credit is fully gone, where the EV market share goes. The Volkswagen Group had limited production in the United States. Volkswagen has a plant in Chattanooga that was operating pretty far below capacity. They were building a plant for Scout, which they weren't planning on selling through the franchise channels. So they just made the wrong bets. And I've had some dealer friends who tell me that Audi management insists on making all the decisions, and then they make all the wrong decisions. And the Audi dealers are kind of left holding the bag. And I feel bad for Audi dealers because, the throughput per store compared to their BMW or Mercedes or Lexus competitors is way lower. So they have these expensive facilities that Audi required them to build, but they're not getting near enough volume to justify the investment. Many Audi stores are breaking even. Many we know are actually losing money. And there's not a lot of cavalry on the horizon for them. So as a result, we've seen the value of Audi stores decline more than any other franchise in 2025. Now, Audi's part of the Volkswagen family. Volkswagen is in a bit of the same boat. They don't have, lots of juicy products coming out that consumers are snapping up. Porsche's in the same boat. Porsche was going hard towards EV. I think they're going to be EV only by 2032. I can't remember the timing that they said. They were talking about giving up models like the Boxster and the Cayman and, really moving away from internal combustion engines. Now they've also learned that that's not what consumers want. And it's not what governments are going to require. So they're scrambling to keep their dealerships supplied with vehicles. I heard the new, I guess he's executive vice president of Porsche North America speak about a month ago. They're going to keep production going for the Boxster and the Cayman. They are going to bring a 3-row SUV to the U.S. market for the first time, but that's still 2-3 years away. So I think that the profitability of every brand in the Volkswagen channel is going to be declining because they bet so much on EV. Conversely, certain brands were a little bit wiser and said, we're going to have a Macy's approach to powertrains. And I remember hearing Bob Carter from Toyota talk about this at the New York Auto Show maybe 4 or 5 years ago. If you want an EV, we'll have that for you. If you want a plug-in, hybrid, we'll have that for you. If you want a hybrid, we'll have that for you. And if you want a gas motor, we'll have that for you. And they have. And they've absolutely killed it in the market since then. They're taking share. The profitability of Toyota and Lexus stores is close to an all-time high, even including the pandemic years on average. Many people were taking markups on cars during the pandemic era. But they absolutely had the right strategy. And now they're far ahead of their competitors. Even brands that were growing quite strongly, before the pandemic and before the EV thing, like Subaru. Subaru just doesn't really have many hybrids yet. They're coming, but they don't have them. So they're losing some share to Toyota. The Korean brands have a good strategy too. Hybrid, EV, gas, and they're taking share. Hyundai and Kia are gaining share nicely.
Yeah. So a couple of things there, though. It looks like the EV market share is going to come in for October a little bit more than half below the prior month, right? So let's say from like 12 to like 5.5%. So it takes us back about 3.5 years. If you look back to the last time we were at that level, early 2022, or say close to 4 years, really. Secondly, you mentioned Volkswagen and sort of anticipating a rough patch ahead, which will impact valuations. The podcast right before this one that I recorded was with Fred Emick from Emick Automotive in Colorado, one of the highest volume sellers of EVs in the country. And I asked him, I said, Fred, what's on the horizon, right? Like, is Volkswagen he's chairman of the National Dealer Council. Is Volkswagen listening, or do you believe you have the right tools to actually effectuate change, or where are we going? And listen, he's a Volkswagen dealer. He was very candid and honest, but he didn't sound, just like he really saw the light at the end of the tunnel. That was at least how I read it. And you can, anyone can listen to the podcast themselves and make their own judgment. But I think putting that and this together, I think it signals some potentially, a bit of a rough patch for the brand for the foreseeable future.
Well, years ago, Mike Jackson, who was CEO at AutoNation for many years, he has a phrase which I remember, which is, there's a battle for talent and capital at auto retail. There's a battle. And if you are an OEM and you don't bring product for your retailers, you show that you don't really care that much about them. In fact, you want to compete directly with them. The retailers are going to react by moving on. They're going to sell their stores. They're not going to put their best people in the stores. They're not going to invest in their facilities. They're going to take their talent and their capital and put it into the brands that are supporting them. And so I don't think that Volkswagen has listened very carefully to its U.S. dealers over decades. It's not new, but it's particularly dire now in a way because during the pandemic, everybody did well. All franchises did well. Every product that came was getting full sticker just about, or way over sticker. But now that you got to compete head to head, Volkswagen is a massive automaker, has all these brands, but are they coming with the right product and powertrains in the next couple years to compete with the Toyotas of the world, or the Chinese vehicles in these other markets? Because China is a huge market for Volkswagen. And there are all kinds of articles about Volkswagen and the amount of capital they need over the next couple of years versus what they have. And so, that's a macro issue with the government of Germany and labor costs and China and tariffs. But in the U.S. market for dealers, Volkswagen has not been a good partner to their dealers. And dealers like Fred Emick are kind of letting them know, which they should. I mean, the fastest thing they can do is put that Scout vehicle in the hands of Volkswagen dealers. They will sell it far better than a Volkswagen website will.
Yeah, it seems like a lack of listening, sort of like Ford circa 2022. And they definitely, I got to give them credit for being more, just attentive and listening to the dealers and making some adjustments accordingly. Putting Volkswagen Group aside, it clearly covers multiple brands. Is there any other brand right now in specific, or brands that are, just in a very transitory period? Anything you see out there?
Well, if you look at Stellantis and Nissan, they had growth in sales in the third quarter. It's the first time, and I don't even know how many quarters that they started growing, which is terrific news for the dealers. I spoke with a large dealer yesterday that has a Nissan store, and he's selling quite a lot of Nissans, but they have these stair-step games that are going on. So he might sell a lot of cars and make no money. And he's also wondering, like, what's the point? Why am I doing this? Maybe I should just move most of my business over to my surrounding stores where I kind of get slow and steady profits as opposed to these peaks and valleys. I think the other challenge we may see for Stellantis and Nissan dealers is, their sales have dropped quite a lot. And there's a lag in the fixed operation business between new vehicle sales and the fixed operations, right? So as you have fewer units in operation, you might have a declining fixed operations base, which is scary because that's the most profitable part of our industry. So those dealers absolutely have to be building a used car operation that can be at least 1-to-1, if not 2-to-1 or even 3-to-1 used to new, so that they can feed that fixed operations base, keep their technicians around, et cetera. Meanwhile, you have other brands like Toyota, where it's just got growing units in operation. That's going to be very positive for their fixed operations. Ford's another brand that we're watching carefully. They've been giving up a lot of their lower priced products and really relying a lot on the F-150 franchise. So from a dealer's perspective, even if you only made $1,000 new vehicle gross on a Ford Escape, you could still do F&I. You could still take a trade-in. You had a product to sell a customer at a lower price point that you could work your way up. But as they walk away from some of these lower priced units, an F-150, I think the average transaction value at a Ford store is $57,000. At a Toyota store, I think it's $42,000. Big difference. So, the customer who's looking for a payment, they're going to keep going more and more towards the Toyota and less towards the Ford, I think, for anything other than an F-150. So we're really seeing a divergent success of brands right now that we didn't see during the pandemic when everybody was doing great.
Mm-hmm. Talk to me about buyer profiles, like who's driving demand right now, especially as demand is rising again. I think it's important to mention that when we were seeing the M&A demand slow earlier in the year, a lot of it was driven by the publics. And what are we seeing now? I mean, almost a year later, who's driving demand in today's market?
Well, there have been several public companies that have bought dealerships this year. AutoNation bought some stores in the Chicago area. We know Asbury bought Herb Chambers, big group of stores up in the Northeast. Sonic bought some stores on the West Coast, some Land Rover stores. So they have been more active this year than in the past, but still the large majority of M&A are private dealers. The private dealers include a guy with one store buying a second store, or a guy with no stores buying his first store, all the way up to a private equity-backed organization that has invested billions of dollars and can take down really the largest transactions out there. So we still put those in the private buyer group, even though they have immense capital. Still a lot of confidence in auto retail. I mentioned all those risks or shocks that were going on. And despite all that, profits went up for automotive retailers in the third quarter. So I think we're going to continue to see strong demand for dealerships. We look back at our average blue sky multiple over the last almost 10 years, and it's slowly gone up on average. Some of it's thanks to brands like Toyota, where Toyota used to be around 5.5, and now it's more like a 7 and change. But also brands like Hyundai and Kia that used to be 3 to 4, and now they're 4 to 5. So a lot of those brands have improved as businesses. We see Hyundai and Kia stores now regularly making north of $5 million and sometimes more than $10 million per location. That never happened a decade ago. So there are some really good brands out there to buy. Conversely, the Nissans and the Stellantises and the Infinitis and the Lincolns and the Volvos are really, really challenged today.
Yeah. I mean, look, it's also, there's more money, more capital chasing fewer assets. And it's, but it is, Kia, it's one of the incredible just accomplishments here over the last five to 7 years of how far they've come. I'd love to understand now from a projection perspective, assumptions. You're into details here with, closing deals, weekly basis. What type of assumptions are you seeing being made right now? We had this conversation, I think maybe a year and a half or 2 years ago, or maybe, even a little bit more than 2 years, when interest rates started rising and dealers were, the last 2 years were an anomaly. I want to look at, since 2019, I want to adjust. But what are you seeing now? How are dealers projecting the environment for the next 12 months? That could be from an interest rate perspective, a discount rate, that could be from just overall volume. I'm curious to know what major trends you're observing.
Well, when people are valuing a store, they're really going to look, they want to know what the store has been making, but they're going to put together their own projections to figure out what they're going to make, and then they'll value the store based upon that. In the past, there have been these formulas. Hey, it's the last 3 years of earnings. You average those and you put a multiple on it, and that's the blue sky number. We're not in that world anymore because the earnings were so high and now they've come down a bit. So most buyers we see are really looking at current earnings as the baseline. They're not going back to 2019. We're still at twice the level of profits we were at 2019. So that's history. That doesn't matter at all in terms of the present valuation. And then they're trying to figure out, okay, this brand that I'm buying, how it's performing, the market, the facility, et cetera, what's going to happen over the next 3 to 5 years. And if it's a Toyota store and it's underperforming, we're showing projections that Toyota will provide them with more units to become sales effective. They can't just manufacture more units. What they effectively do is take it away from the other dealers. So if you have a Toyota store or you're buying a Toyota store and the store is not sales effective, we're projecting that over a 12 to 24 month period, a buyer will be able to make that dealership sales effective. So that's going to go up. And often when people are selling their stores, they're not operating at their peak. Maybe people have gotten a little bit inattentive. Maybe management goes home earlier than they used to. Maybe expenses have creeped up. So in most cases, when people are selling their stores, we can identify an opportunity for the incoming buyer to do better, which is a win-win, because that means that a buyer can pay a strong value for a dealership and then improve it and get a good return on investment. That's the win-win. Where we have a challenge is when a seller's got a rock star GM and he's 200% sales effective and the use-to-new ratio is 3 to 1, and then we go to sell that store and buyers might be a little bit afraid of the performance.
Are you seeing any reluctance or hesitancy driven by the government shutdown, the mayor of New York? I know that's very regional, but, again, just gleaning insights from chats and seeing the DC-based, Virginia-based dealers talking a little bit, of somewhat of a slowdown. I'm curious to know if that's trickling yet into the buy-sell market in any way.
Not that event. I think people view that as a temporary event. It's happened before. There's a stated belief that President Trump wants to shrink the size of the government, and maybe this is one way he's going to do it, right? Is just get people to quit. And certainly that's more of a local thing than a global or national event. I feel badly for those people that are doing their jobs and not getting paid. So we do need to solve that. It's not fair to them. But in general, the economics nationwide are pretty good right now. California can't really enforce the CARB laws, so dealers are going to have the full inventory of vehicles to sell to customers. Economic growth is still pretty good. Inflation is 2-3%, which is not hurting anybody. Unemployment is not popped up, even though we hear about companies laying off workers. Maybe it's AI related, or maybe they just are shedding excess workers. So that's a little concerning. I have a daughter that's graduating from a master's program this spring, and I'm kind of wondering what her outlook is going to be for getting a job. We still see people.
That is very concerning.
Yeah. So we have to put her on the front line selling cars if anybody needs a nice young lady to help her sell some cars. I think that's one of the best.
Always bet on that.
Yeah, I mean, she's been the card girl at the University of North Carolina, the golf course out here, so she knows how to talk to old guys. So we still see a lot of demand for stores. Now, sometimes when people call us, it's interesting because I say, I want to buy a dealership. Where would you want to buy? What brand? How much you want to pay? We do these kind of screening. And I would say a decent number of them say, I want to buy a dealership in a red state. I never remember hearing that description my whole life, that investments were just driven based upon, the politics of that state. Now, we knew certain states like California, New York, et cetera, were more challenging, higher tax, et cetera. But there were still plenty of investment dollars going to the states because there are lots of wealthy people and there are lots of commerce in the states. But I got a call last week from a dealer in Hawaii, wants to expand, skips right over California, which is a natural place for them to go. And where do they go first? Arizona, Texas, even the Carolinas, maybe even Florida. So that's a long darn way for that dealer to fly to buy a store because they're kind of done with the politics in the blue states. Now we have other friends that are investing in California and doing great. So, but that red state, blue state is the first time I've heard that. And maybe it's just a reflection of this division we have in our society, the polarization that's happened during the last decade. Maybe that's social media or other reasons. But we've got some transactions going on in California now where the valuations are really strong. In fact, we had one transaction. We marketed it when CARB was in place. People were concerned about it because these brands didn't have many hybrids. We accepted an offer, and the buyer was so slow that we ended up walking away and remarketing, and we got an offer that was 30% higher, more in blue sky. So,
wow.
And after CARB was gone. So to me, that's an example set of one. So I don't know that it's a massive law, but the value of that dealership group was significantly higher without CARB than it was with CARB. So I'm very hopeful for the other transactions we have going on in California. In fact, I know because reading the numbers, buyers are eager to do business in California again, whereas for a long time they were looking to take capital elsewhere.
Yeah. Yeah. Again, there's so much capital chasing these assets that, there's always going to be buyers for, an asset almost anywhere in this industry at the moment. Sticking on the topic of valuations, I'm friendly with some dealers in Miami and New York, and there's been a lot of talk about vehicle brokering. And specifically, I was asked about, the perspective on dealership valuations and brokering. Is this, you think about a dealership and depending on what percentage of their business they actually do through brokering and not as, direct sales. But, some brands are very heavy into this right now. And is this something that you've thought of? Is this, do you see this as a big risk to these brands to dealership valuations if these brands are starting to get, more protective and, going to start cracking down on brokering? Or do you maybe see it as an opportunity to get in with these brands today before they do that? I'm curious to know if, this topic is something that has crossed your mind recently or, you've been asked about it.
So brokering is something I became aware of maybe 12, 15 years ago in New York. We were selling a Mercedes store in Brooklyn. And that's when I sort of realized, oh, there's certain communities, like in the Jewish community, a lot of people go to their rabbi to make financial decisions. And often their rabbi will help them purchase cars, and the rabbi is the broker. And the rabbi is going to take a cut, and everybody's okay with that. But it makes it hard to sell a store if you're doing a lot of broker business, because will those brokers stay with you? If you turn down that business, what's the natural demand for that store?
Affiliate deal. Yeah. There's no loyalty. Yeah. It's a cheaper sale. There's no loyalty to it.
Yeah. In California, there's more national type brokers, or somebody from the Persian community, people who immigrated from Iran. They've got somebody, a man or woman, they go to help buying cars because they don't want to go into the stores. Korean, Vietnamese, et cetera. There's certain communities where this is pretty prevalent. So it makes it more difficult if you're buying a store to know what the real level of demand is. Now, I think that, pardon me, it also, a lot of the factories don't like it because they don't know who the customer is. The retailer doesn't know who the customer is. Sometimes they're not even provided with a lot of the information of the customer. And so that makes it harder for the factory and the retailer to stay in touch with that customer for the after sales, the parts and the service. And factories care a lot about getting that customer back in the dealership because they make a ton of money off selling parts to the retailer, who then puts them on the cars of the customer. So I have heard, I believe Mercedes is doing this, that they're beginning to enact policies to reduce the level of broker business in their stores. And it may be in the terms where if you're selling a lot of units to customers that are outside of your area, perhaps you don't get the same margin on that car. And I don't know the details yet, but I do know that that's going. And that's a positive for the retailer, and that's a positive for the factory. And ultimately, I think it'll be positive for the customer because now they have a relationship with a dealer. If they have a problem with the car, if they have a problem today, the rabbi can't fix it, right? So it's helpful for them to have a relationship with the retailer. So this change, I think, will be for the benefit of dealerships, particularly in Los Angeles. You mentioned Miami and the Northeast, where brokers are important. Just like a couple years ago, Toyota, I believe, put in place minimum advertised prices to prevent retailers from selling well below invoice. And that had the effect of boosting margins for everybody in the Toyota world and making that business model even better. So I know sometimes the retailers complain about the OEMs that do things that take money out of their pockets. But if the OEMs can take actions to eliminate or reduce the broker business, that's going to be, I think, a very positive thing for the retailers in those communities.
This episode is brought to you by Amazon Autos. Are you ready to grow your dealership? Amazon Autos drives customers right to your doorstep by connecting you with millions of ready-to-buy online shoppers. Whether you sell new, used, or CPO, Amazon Autos provides the digital storefront for customers to shop while you maintain control of your inventory, pricing, and customer relationships. Stop wasting time and money chasing leads and start earning done deals with Amazon Autos. And for a limited time, new Amazon Autos dealers pay no listing fees for up to 6 months. Go to sell.amazon.com/program/autos to learn more, or click the link in the show notes below.
The way I see it is it would likely grow profits, which would grow valuations.
Yes, exactly, Yossi.
Yeah.
I should have asked you the question.
Well, I wanted to get your perspective. You're the expert.
Yeah.
Talk to me about, I guess now zooming back out, just general brand. Are you seeing any new OEMs enter the, must own sphere, or maybe must sell sphere? We spoke about VW Group, we touched on that, but anything kind of recently get, creep up into must own sphere due to, OEM strategy, anything else, any other positive momentum you're seeing there across any OEM?
I mean, to us, there's certain value brands that we like, in terms of return on investment. I would put the General Motors stores into that category, where they sell between 3 and 5 times earnings. They're very stable. They have great fixed operations. If you can get a dealership in a growing area, you'll have some wind at your back. We did some math, Yossi, about the very positive return on capital for Ford stores or General Motors stores buying neighboring stores and closing them down. And I'd be happy to share that math. I don't know how I do it on your channel, but you really, even using pretty conservative assumptions, by closing down some of these stores, because they're over-dealered, But if you can buy some of these stores, and Ford, I believe, has got some capital to help do this, you shut down those stores. Even if you lose half or 2/3 of the customer base, you pick up that gross profit with really no incremental expenses. It's a really good deal. So we like Ford. Ford, we wish they weren't walking away from some of their lower priced products, but their truck franchise is excellent. If you really know trucks on the commercial side and you build out, the Ford Pro type business, that's a business model we like that's maybe undervalued today. We already talked about the Korean brands. Toyota and Lexus are like buying a bond versus a stock. It's going to be a great place to put your capital, but the prices are so high, it may not provide the best return on investment. The Korean brands have a product allocation strategy where if you buy, let's say you're a good operator, you buy an underperforming store, Kia will absolutely give you lots and lots of product until you say enough. If you buy a Honda store or a Toyota store, you have to play in the turn and earn system. And unless you buy a big underperforming store, it takes a long time to earn that allocation. So it really depends upon your strategy. If you got a lot of capital and you want to buy a store that's not going to take a lot of work and just make you a good return, you focus on Honda or Toyota and Lexus and maybe some of the luxury brands. To us on the luxury side, I think Mercedes is the buy now. Mercedes took some policies that I believe reduced their profits. They went so far on the EV side, they made dealers take all these EVs, and the dealers lost a ton of money on them. They didn't really bring new products for Mercedes dealers to sell. So Mercedes market share has gone down. They were negative this last quarter by about 8%. BMW conversely was up by about the same percent. Mercedes also had a policy of trying to restrict or prevent buyers of their stores from, if they weren't already a Mercedes dealer, they didn't want you to buy one of their stores. And so that shrunk the demand for the stores. And now they're walking away from that. They're allowing people that aren't Mercedes dealers to acquire their stores. They also were trying to restrict the number of Mercedes stores that dealers could own to, I think it was 6 or 7 without entering a framework agreement. They've now pushed that to 9. So I think one more thing is Adam Chamberlain, who's the new president there, Mercedes-Benz USA, he and his team, and he's got Greg Gates back with him as well. They want this brand. I love this quote from a dealer. They want Mercedes to be aspirational again, not unobtainable. And by that, they mean at what prices they were selling their vehicles. They raised their prices so much that a lot of their customers said, I just can't afford to get a new one. So they want to go from selling about 300,000 units a year to 400,000 units a year, really in the next, I think it's 3 to 5 years. So this could be a low in terms of profitability of a Mercedes store because they had to suffer all the losses of flushing all those EVs out, and their other vehicle sales dropped. So their profits per store are probably lower today than they have been quite some time. And if you believe in Adam Chamberlain and Greg Gates and the rest of the team there and Mercedes, in Germany to bring the right products to the U.S. market, could you get a 33% lift in sales, 300,000 to 400,000 without adding more points? That would be a home run. Yeah. You could buy a Mercedes store today at current earnings and the current valuation.
And if you are Adam Chamberlain or a Mercedes dealer listening, shoot Adam Chamberlain a text and tell him, let's do a podcast. We have to have a discussion about this. You mentioned the Korean brands. I was jotting this down. I had a couple of dealers. This is a new one for me, but I had a couple of dealers just, one dealer told me, hey, I'm seeing some friction on the Hyundai side and Kia. Another dealer told me they took an unexpected loss on their Hyundai store. Again, I haven't dug into this. It's still very fresh, but I am curious if you've heard any rumblings with respect to Hyundai, Kia, from dealers, or have you've seen anything reflect in any deal activity whatsoever?
So it's an interesting company because
it's a new one.
I believe Hyundai is the majority shareholder of Kia, and the products that they make they're not clones, but they're brothers or sisters, right? So a Telluride is pretty much the same as a Palisade. But the two companies don't really get along. Like, I think Kia absolutely wants to sell the pants off of Hyundai. The Kia management is perceived as more friendly to dealers than Hyundai. I think Hyundai is a little bit tough. They maybe choose favorites. So if you're in the club, you get a lot of product, you get ad points, you get rights of first refusal offered to you. You have, you're paddling downstream with Hyundai. There's a perception, if you're not in the Hyundai club, then maybe it's hard to get the product. Maybe the stair-step, incentives are unfair for you. And so you're almost encouraged to maybe you should sell your store. And by the way, we know who you should sell it to because he's our favorite child. Don't sell it to somebody else, sell it to our favorite child. So that's, Hyundai dealers have felt like that's not the spirit of partnership I'd want from my factory. And that's, hopefully I'm not being critical of Hyundai. I think they developed an amazing product and they've taken so much market share profitably over the last 10 years that I have a great deal of respect for what they've accomplished. I'm just talking about from the retailer's perspective, what we hear. Now, on the Kia side, I think it's viewed as a little bit more of a level playing field. If you're a good dealer, you're going to get the cars. And if you can sell all those cars, they're going to give you more cars. And the facility requirements that Kia and Hyundai have, this is for both of them, I say, are reasonable compared to certain other brands like Audi, where they have this very expensive cost to build a facility that in the end doesn't really sell that many cars. Hyundai and Kia, we really like those brands because you can sell a lot. The cost of the facility is not that much. You have to update the image, but it's a few $1 million, not $7 to redo a showroom like with Audi, or 15 for Audi. So we're fans of those, but I think that the perception is that Kia is a more dealer-friendly company than Hyundai, and therefore we have Kia stores at a higher multiple than Hyundai, even though it's the same product.
Yep, I've seen that too. Alan, before we wrap up, it's been very insightful. I'm curious to know what's your pulse on the market for the next 3, 6, 9 months. I mean, what are you forecasting here for this next year as much as you can? Because we know it's been a period of rapid change, but are we going to see the M&A market accelerate, stabilize, slow down? What's your sense on the market right now?
I believe the market's going to continue as it is. I think that we've had all these shocks we talked about and things are still going. I think that, every retailer has a goal. If they are older, their goal might be to stay in for a couple more years and do the best they can and give their communities and employ their people and continue to do well. If they're younger and they want to grow, they're looking for that acquisition opportunity. I don't think anybody ever feels like they get a good deal when they buy a dealership, But I was making this analogy, Yossi, and I brought a visual aid if you don't mind me showing. But so this is the medal that everybody who finished the line got. It's a really nice medal. It looks like the medal for the Paris Olympics last year. And I looked at it, and they gave it to everybody, right? The winner got the same thing as this, except they got a big check. But I think all of us have got our objectives, right? And we're all marching towards these, and maybe we hit our objectives, maybe we don't. But I don't see anything on the horizon right now that's going to really change the economics of auto dealerships. You mentioned Carvana. There's 17,000 stores. Carvana now owns 2. Could I see them owning hundreds of dealerships in a decade or two? That's possible. Would that change the economics for dealers? Likely. However, I also believe that dealers won't stand still. They will react. They will adopt their own digital retailing. They'll respond more on the fixed operation side. Hey, if I can't compete as well on the variable side, I can own the customer on the fixed side. And I have a new teammate, John Murphy, comes from us from Bank of America Merrill Lynch. He's developing some research that shows how massive the opportunity is for franchise retailers on the fixed operation side, that they're just letting go to the independent shops. So our business will change over the next decade as new entrants like Carvana come, or we have autonomous vehicles rolling around. But the one thing I know is that the franchise retail system is going to respond to those threats and the opportunities. Remember, we're still selling 16 million cars a year. We're probably 8 or 10 million units short because of the pandemic. We have a lot of pent-up demand, in my opinion. So I think that the retailers that are out there see all the risks. They're out there running their own races. They got their own prizes in mind. And it may not turn out the way they expected. Like I didn't run nearly as fast as I would. But I think that they're going to invest and work hard and build their companies just as they always have. So I have no real worries right now about how the next few years are going to be in our industry.
Mm-hmm. And I think your point on fixed ops is a great one because, I recorded with Nowling Auto from Texas, or Ryan Nowling, the other day. And, we were just talking about the emphasis he's putting on fixed to the extent that he said, Yossi, he said, I am selling a car to get a service customer. He said, I don't care about front end profit. I don't care about profit on a new car. Again, he's on the more of extreme end of operators today, but he straight up said, I want that lifetime value. I want that retention. And it's working for him, but just that all in on fixed ops mentality. We're probably going to see a lot more of that as the industry, heats up. There's more competition, and inevitably, in my opinion, margins continue to compress on the sale of a vehicle. I don't think you have to be a genius to believe that. So I think that's a good point. And I'm looking forward to seeing what John Murphy puts out, because it makes sense that there would be a ton of opportunity on that side of the business.
Yeah, I mean, it'll be interesting too, Yossi, is if you look at the performance of the Stellantis dealers and markets where Carvana's opened. If I could see how Carvana would be taking new share, but they're going to be taking new share, not just from Stellantis dealers, but from Ford dealers and Chevy dealers and really the whole market, right? And if they sell a lot of additional units, those units go back to their homes and they're closer to the existing stores, you might see Stellantis dealers around Carvana stores sell fewer new units, but do more fixed ops. Are they worse off that way? It's not clear. So I think it's really uncertain. But what is certain is the resiliency of our dealer base, our dealer friends out there, that they will find a way. They've got 5 departments, right? New, used, finance, insurance, parts, service, body. They're going to find a way to make money.
It's funny you say that, because I'm talking with a dealer right now who's right next door to a Carvana store that I believe just opened, new car store, the Texas one. And, you can look this up. And we're just talking about strategy. Like, okay, so how are you planning to compete? Like, what's a creative, angle or positioning that you can take being across the street from a Carvana store? And that's an interesting idea that you just presented. It's like, hey, let them get their new car business, maybe conquest their service business. I don't know, but you're right. I mean, TBD. It also begs the question, what percentage of their sales are happening out of market? And, that's, of course, a customer that's not local, but it's, we're going to follow that closely. We'll see how it shakes out.
Yeah.
All right. Well, Alan Haig, Haig Partners. Alan, always a pleasure. Thanks for coming on. And, it's been super fun. So I enjoyed it.
It's a pleasure to speak with you as always, Yossi. Talk to you soon.
Bye.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.